Hello, in this presentation we will record the purchase of music equipment with debt. In other words, we're going to purchase $5,000 worth of music equipment and finance that equipment within QuickBooks Pro 2018. If you've been continuing along with us, we will be working with the Get Great Guitars problem. If not, that is okay. We will demonstrate the purchase of equipment through financing. We currently have the Home tab open. If you don't have the Home tab open, it can be found under Company and Home Page. We also have the Open List open over here, Open Windows. That can be found at the View tab and the Open Window List. If you have the backup to this point, you can restore that backup by going to the File tab and restoring the backup. That will get us all to the same point so we can put in the same information as we go forward. Currently, we are going to be entering equipment. We purchased equipment, we financed it. A couple ways we can do that. We cannot do that the traditional way, however, and that is that we would just basically write a check for the equipment or possibly enter a bill and then write a check at a later point in time, because the financing is going to be a bit longer term. So if we were, for example, to create a bill for it, it would go through accounts payable and we would create a liability. However, it wouldn't be in notes payable and we wouldn't be recording interest on it. We can't write a check or simply put it into the check register as we normally do. Most of our journal entries we've looked at are driven by some of these forms, or we write a check for it and that makes the journal entry for us. We can't do that at this time because there's no cash involved in this transaction at all. So we're going to have to fall back on some other method. One method is obviously we can make a journal entry for it. So this is one of those types of transactions where we might have to look at debits and credits. If we understand debits and credits, then we can just make a journal entry and put it in the general journal. The way to do that would be to go to the Company tab and make journal entry. And if we were to do that and we bought equipment on account, we would just debit the equipment account and credit the loan payable, increasing the amount of equipment and increasing the loan. If we don't want to work with debits and credits, however, QuickBooks does give us other options that we can use as well, and that would be the registers. So if we go into the banking option, and that's what we'll work with now. So we'll do the same thing. It'll be a journal entry. Everything we do in QuickBooks, most things, is a journal entry, or QuickBooks makes a journal entry through what we do. But this is going to be a way that we can do it by saying increases and decreases rather than debits and credits. So if we go to banking and say use register, we usually use the check register, but we can actually see a register for any type of account we want to look at. If we're going to be purchasing equipment, we could go to for debt. We can go to any of these two accounts. We can go to the equipment account or we can go to the loan payable account. Either of those two accounts will work. If we go to equipment, we're going to say that we're going to increase equipment and the other account will be loans payable. If we go to loans payable, we're going to say we're going to increase loans payable and the other account will be equipment. Let's see what that looks like. I'm going to go to the equipment account. That makes more sense to me. So I'm going to say furniture and fixture. That needs to go up because we bought more of it. So I'm going to click on that and we're going to see a register when we select OK for that equipment account. Probably not too much activity in your equipment account activity because you're not buying and selling equipment every day. If you were, it wouldn't be equipment, it would be inventory. And therefore, there's probably not so much action going on here. But note, all we have are increases and decreases. So I don't need to know that I need to debit the equipment account to make it go up this way. We can just put this information in terms of increases and decreases. So we're going to put the date. I'm going to say 02/28/21, the end of the month that we are working on in the year 2021. And we're going to say that we're purchasing from Office Depot. And we already have this vendor here, so we're just going to type that in. There's the vendor. We are going to increase the equipment. So it's not in terms of debits and credits. It's in terms of increasing and decreasing. Us being in the furniture account, we're going to increase the furniture account by $5,000. And then we just need to add whatever other account is affected. That other account happens to be, in this case, us financing it. We're going to put that into an account called loan payable. We already have a loan payable set up here. So if we scroll up, it's going to be an other current liability. If we start typing it in, loan payable, there it is. If you were to set up a loan payable, you would want to set it up as either long-term or current liability depending on the terms. We're going to say here it's going to be a long-term liability, and that's how we're going to set this up. So if you hadn't set it up, you want to type in loan payable tab and then set up the account as a long-term liability for that. So we're going to tab through this. It's also possible, note, that we're going to record all of our loans into this loan payable account. And if you have multiple loans, you might actually want to list out the loans separately on the trial balance and have the loan number so you can track them separately with their own line items. And then when you make the financial statements, you might want to group them together all in one line item called loans payable. In this case, we have few loans, so we're going to put them all into our one group of loans payable. And note that it does not record unless we hit enter to be on the next line. So we should say enter. Now it's on the next line. What's this going to do? It will obviously increase the office furniture or account, the accounts we are in, by the 5,000, and it will increase the loan payable by 5,000. Let's see if that's the case. We're going to go to our reports and check that out. Reports drop down. We'll start off with the balance sheet. We're going to go to company and financial. Scrolling down to the balance sheet, standard format. Going to change the dates by going up to the top in customize report. And we will then tab through the dates and go to 01/01/21 to 12/31/21. So January 1st, 2021 to December 31st, 2021, and OK. There is our report. We didn't pay cash for this. What did we buy? We bought furniture and equipment. That's going to be here. So we'll double click on that item. And we see the furniture and fixture there. There's the 5,000. Double clicking on that, we get back to our register where we have input this information. Closing this back out, closing this back out. We're going to go to the other side, which is not going to be an accounts payable, but loans payable because we financed this item. And we do have other loans out apparently. So we're going to double click on the loans payable, and grouped within the loans payable, we have the 50,000, and we now have this 5,000 here within the loans payable. We're going to double click on that, and there is our amount again. So the loan is on the books. Note that when we think about this in terms of financial statements, we do have to consider whether or not how much of this loan is going to be short-term, how much of it is going to be long-term, and when we create the financial statements, we'll have to see how much of the principal will be paid in the current portion and how much of it will be paid in the long-term portion to adjust for this loan payable.